Explainer: what's new with the Fed's financial institution stress tests in 2022? Washington: the U.S. Federal Reserve will release the consequences of its annual bank health assessments on Thursday. Under the pressure, take a look at workout installed following the 20,072,009 economic crisis. The Fed assessments banks' balance sheets in opposition to a hypothetical excessive economic downturn, the factors of which exchange yearly. The outcomes dictate how much capital banks want to be healthy and what sort of they are able to go back to shareholders through proportion buybacks and dividends. How well a bank plays dictates the size of its pressure capital buffer, an extra cushion of capital the Fed calls for to weather the hypothetical downturn, on pinnacle of regulatory minimums required to help each day commercial enterprise. The larger the losses under the take a look at, the bigger the buffer. Here are the highlights of this year's tests. The rollout: the Fed is anticipated to launch the outcomes after market near on Thursday. Rather than passing or failing lenders, it normally publishes every bank's capital ratios and mixture losses underneath the check, with details on how their particular portfolios like credit score, playing cards or mortgages fared. Banks are not allowed, however, to announce their plans for dividends and buybacks till the subsequent Monday, June 27. The country's biggest lenders, mainly J.P. Morgan Chase & Company (NYSE), JPM, Citigroup Inc. (NYSE), C. Wells Fargo (NYSE), WFC & Co., Bank of America Corp. (NYSE), BAC, Goldman Sachs Group Inc. (NYSE), GS, and Morgan Stanley (NYSE), MS are closely watched by way of the markets. A tougher test? The Fed changes the situations each year. They take months to devise, which means they hazard becoming outdated. In 2020, for example, the real economic crash caused by the COVID-19 pandemic was by means of many measures greater severe than the Fed's situation that 12 months. The Fed devised this 12 months scenario earlier than Russia's invasion of Ukraine and the cutting-edge hyperinflationary outlook. Still, the 2022 check is predicted to be greater tough than closing year because the real financial baseline is healthier. That way, spikes in unemployment and drops within the size of the economy below the check are felt extra acutely. For instance, the 2021 stress: take a look at estimated a 4% factor leap in unemployment underneath a severely unfavorable situation. In 2022, that growth is 5.75 percent points, thanks in large part to growing employment over the past 12 months. As a result, analysts count on banks can be advised to set apart slightly more capital than in 2021 to account for anticipated boom in modeled losses. Stresses in commercial real estate, corporate debt. This 12 months' tests will also encompass heightened stress in industrial real property, which turned into hit by the pandemic as people had been sent home, and corporate debt markets. Global watchdogs, including the International Monetary Fund, have warned of high ranges of risky corporate debt as hobby charges upward push globally. All banks tested in 2022, all 34 U.S. banks monitored by means of the Fed with over $100 billion in belongings will undergo the strain. Take a look at, compared with 23 lenders last 12 months. That's due to the fact the Fed adopted a new widespread in 2020 that stipulated that banks with much less than $250 billion in belongings most effective ought to take a look at each different 12 months. That manner that huge regional banks, like Ally Financial (NYSE), Ally Inc. and Fifth Third Bancorp (NASDAQ), FITB, are up again after a 12 months off.